Welcome back to the channel, everyone. My name is Amos, and currently this is part 2 in a 2-part series. We're ranking, grading, and evaluating software stocks up against one another to figure out which ones are the best deals on the market right now in this economy, by the way. But before we jump into part 2, I wanted to make a call out that I made a mistake in part 1 when we talked about the 7 stocks that you see on your screen right now. I did not address or discuss the rule of 40. So essentially, it's a metric that tells us whether or not the company in question balances their revenue growth with profitability. Because sometimes a company might hyper-focus on growing the top line and disregard being profitable. And that's a huge red flag, right? So the rule of 40 is a company needs to hit 40% or higher. That's the golden standard. Anything between like 30 to 40%, yellow flag, not the worst thing in the world, but anything below 29.9%, you have to wave that yellow flag. Anything below 25%, obvious red flag, and it's going to be a value trap in the world of SaaS stocks. So as you can see, out of the 7 that we talked about in part 1, Duolingo is the king. 76.7%, absolutely efficient of a company. And then I would argue Adobe and ServiceNow are tied at about 52%. The worst one out of the bunch is unfortunately Toast, but that's also because they make hardware, a physical product that they sell to the restaurants. And I wanted to bridge the gap by explaining the rule of 40 because some of these companies, they trade for a really pretty premium, right? And I talked about that in part 1, and that's because investors, they're often willing to pay for that fat premium if the company consistently scores above 40% in this metric. It's the golden standard, and if it's above 40%, they're willing to buy into it, knowing full well that the PE might be like a 35 or even a 50. Hopefully that makes sense. And now let's get on with part 2. I love you guys. Now picking up where we left off, let's continue with Guidewire. They're in the business of selling the core operating software for the insurance industry, a very niche customer, okay? And as AI replaces more human agents, I think insurance companies are going to rely even more on Guidewire's software to run the policies, underwriting, billing, claims. I'm not sure if actuaries are going to be affected by AI, but we could probably throw them into that category as well. So Guidewire, ticker symbol GWRE. Take a look at what we are cooking with, friends and family. By the way, when I was a kid, one of my favorite shows when I came home from school was Emerald Live. It was like this Italian dude that just cooked the most ridiculous dishes, and he had the signature motto of going, bam, bam. Anyways, I don't know why that reminded me of Emerald Live. But anyways, Guidewire software, I'll be honest with you, out of this entire list so far, they're trading for such a premium that I'm taken aback right now. Okay, because they're going on a massive sell-off. I'm not exaggerating. Year to date, which is only 2.5 to 3 weeks, 20% into the red. Past 1 year, negative 8% into the red, and they're still trading for a 150 current EPS PE ratio, but the next year's forward trading multiple is a 50. That's fat. Dude, they're trading for perfection, but I'm going to show you why the market loves Guidewire, even though they're selling out of them. Take a look at the growth in their revenue. $400 million in 2016 to $1.2 billion in the trailing 12 months. So the top line situation, except 2021, is phenomenal, is magnificent even. Take a look at their profitability situation. I think up until 2025, that's rough. And I think that's because they were making a lot of mergers and acquisitions, which messed up their books. So I think instead of looking at the earnings per share, which is also known as the bottom line per share, I think it's more fair to look at the free cash flow per share to see what cash is actually generated from the operations. And that's going to be $3.32. So having said that, $3.32, what is their price to free cash flow ratio, which is an alternative to the price to earnings ratio, the PE ratio, 158.9, and we could divide that by. So their price to free cash flow ratio is a 47.8. Makes it a little better than a 150, but it's still freaking fat. Let's take a look at their books. $1 billion of cash. It seems to be what they want to maintain on a high level because it seems pretty consistent. How much loans? $700 million. So after accounting for all the debt on the books, they have $300 million left over. Phenomenal right there. I'll keep it 100 with you. I think their financials are phenomenal, okay? And I love the fact that Guidewire doubles down on the industry that Warren Buffett loves the most, which is the insurance space. But what I don't love here, friends and family, is their valuation. Even though they're selling off and I love the prospects of their future, I just don't think it's a good deal. So, having said that, I think because they're missing one, I think it's more than fair to place them into this bucket right here, right next to Intuit and Toast. And when we calculate the Rule of 40 for Guidewire, the revenue growth year over year is 22.8%, and their free cash flow margin is 22.5%, so it adds up to being 45%. Absolutely delicious and beautiful, because the standard is it needs to at least be a 40 when it comes to a software as a service business. And this comes as a surprise to me because the next software company that's on a sell-off right now is Microsoft. Ticker symbol MSFT. Let's pull them up as we talk about them. I don't even know if they need an introduction at this point. I think everyone understands who they are, but they're basically an enterprise software giant. Some might even say a conglomerate, okay? They're the parent company of Azure Cloud, Microsoft Office, a social media platform known as LinkedIn, which, between you and me, I absolutely despise. Okay, I don't like LinkedIn. But anyways, they even have a gaming division with Xbox and Blizzard. But did you know, if you have kids and they say 6, 7 around the house, they also own Minecraft, okay? That's the parent company. It's Microsoft. And they're currently $4.60 a share. But unlike the other Mag 7 that seems to be roaring to the sky, I think also Meta's on a sell-off, but I wouldn't categorize them with this video because I think Meta's in a different category. But anyways, year to date, Microsoft's 5% into the red. Past 1 year, 7% into the green, but ever since October when they reached a high of about $555 a share, they've just been dipping. Literally selling week after week. Their current trading multiples are 32, but remember, with growth, tech, software-oriented stocks, always look at this one right here, the forward trading multiple, 27.6. The average PE ratio of the S&P 500 is a 31. So in comparison to their peers, and especially the Mag 7, they're undervalued. Microsoft, honestly, this is about as high quality as it gets. When people talk about the best stocks in the market, the best stocks for beginners, the best stocks for XYZ, Microsoft always deserves a spot at the table. They belong in that conversation. You can buy and hold Microsoft for a really long time. Revenue situation is good. EPS, do I even have to go over their numbers? Just trust me when I say their numbers and financial fundamentals are phenomenal. Now, if you're curious about my fair value estimate for Microsoft, did you know that I actually made a 3-part video series that covers the price targets for over 30 stocks? And I just uploaded that series not too long ago. So go and give that a watch. Now, when it comes to Microsoft, if we take a look at the 3 criteria metrics that we're assessing these software stocks on, business quality, their economic moats, super high, vast, beautiful. Probably one of the best. Financially and their fundamentals, I just don't think it gets any better than Microsoft, right? But when we talk about their valuation, I'll be honest with you, I'm not interested in buying them yet. Okay, because my personal buy price target is if they drop to 400 a share. Some of you heard that number and you already clicked dislike. You already wrote a very racist comment and you decided to delete it. But I do think Microsoft could reach 400 a share. Now, if they do, that's when this tiny little ear is going to open up and I might start to dollar cost average. So Microsoft, as crazy as it might sound, in comparison to the other software stocks, I think they're only good. I don't think it's one of the best deals out there right now. I don't. So I'm going to place Microsoft into the same column as Intuit and Toast. And when we take into consideration the Rule of 40 for Microsoft, their revenue growth year over year is 15.6%. Absolutely juicy for a legacy tech company. Like, dude, Microsoft, they're in the same realm as IBM, Cisco, but for one reason or another, they always find a way to grow at a double-digit rate. They're relevant in today's business environment. And the free cash flow margin, we're going to add that up at 26.6. Oh my gosh, 42.2. So they barely make it above the Rule of 40, but it still confirms that Microsoft is a beautiful dividend compounder with Parmesan. or I guess mozzarella, depending on your mood. And the next one, friends and family, is GitLab. It's a one-stop shop for developers to build and roll out software and mobile apps. And I'm going to tell you this right now. You ought to pause this video, walk on over to your garage, and put on your bicycle helmet, because things are about to get really crazy. Because as I pull up their numbers, ticker symbol GTLB, dude, they're ridiculous. But first, let's take a look at what's going on with their stock price movement. Past 1 year, 45% into the red. I mean, does it come as a surprise? This is the exact same situation that we saw with the food CPG stocks last year, right? General Mills, Flowers Foods, Conagra. By the way, unfortunately, I did have to sell at a loss. Out of all of them, it sucked having to sell at a 15% loss, but it is what it is. You live and you learn and you laugh and you floss your teeth at night. But anyways, with GitLab, their forward trading multiple is a 35, and take a look at their numbers, okay? This is a company that a lot of people have never heard of, but if you are a mobile app developer, you already know that you prefer GitLab over GitHub, which is owned by Microsoft. Take a look at the revenue situation, dude. This is just crazy. And this line item right here, I really want to emphasize and call out. Because when you take a look at how much loans they're drowning in, it's a big fat zero. They have 0 loans on the books. So when you want to talk to me about a cash-heavy company that's in the business of writing and generating all the future apps that we don't even know about, the next TikTok, the next YouTube, talk to me about GitLab. $0 of loan obligations. And because they don't have a current trading multiple because of the negative earnings per share with accounting engineering, let me calculate it with their price to free cash flow. Okay, so let's see, clear everything here, $34.14. We're going to divide it by their free cash flow per share. This is a really good alternative to the price to earnings, because usually when a company posts negative earnings, they usually have positive free cash flow, especially in the context of a software business enterprise. We're going to divide it by $1.47. So their PE would be a 23. And I do that because it's the price to free cash flow ratio. So a 23, not that bad, right? I mean, I know their forward trading multiples of 35, but if you do it based on their free cash flow, it's not that bad. So when we think about the 3 criteria, I'll be honest with you, I don't think they have an economic moat. I do know that developers, they do prefer GitLab, but I don't think they have a moat that protects them from GitHub or some of the other alternatives in order for you to write code or develop software. But when it comes to their financials and their valuation, I think those are both obvious yeses. Now, obviously, if you are a developer watching this video, please put me on. If they do have an economic moat, let me know, because I am invested into them, and I certainly think they're high quality and I love them, but I just don't know if they have an economic moat because I don't use their product, right? So GitLab, I think, yeah, they're in the same category and tier as Intuit and Microsoft. They're just missing the economic moat. And when we calculate the Rule of 40 for GitLab, their revenue growth is 27.4% year over year. Do that by the free cash flow margin of 26.7%. And friends and family, it's 54.1%. Are you freaking kidding me right now? And that's why their forward trading multiples at 35. And it's not too expensive. When you're pulling off numbers like that, dude, sign me up right now. And the next software company that we are going to explore is NICE. And NICE is an AI-based customer support software. They're headquartered in Israel, by the way. So they're in the business of selling the chatbots, workforce analytics, and compliance software for HR. And I'll be honest with you, even though that is probably the way of the future because it helps bring down the overhead costs of having a human pick up the phone. Dude, it absolutely drives me up a wall when I have an issue and I make a phone call to XYZ and then it's like, bam, I'm talking to a robot. Dude, it pisses me off beyond belief because I would rather speak to a real human. I don't care if they're in the Philippines or in India. I would rather speak to them to resolve the issue or conflict that we have at hand than talk to AI. I think the only times where AI is acceptable as customer support is, I don't know, holidays where the human deserves that day off. You know what I'm saying? So like 3 weeks for Christmas or the winter period, a week off for Thanksgiving, a week off for Easter, and the list goes on and on. I think AI chatbots or whatever, acceptable. But to implement and use only AI bots every single day of the year. It drives me up a wall. By the way, the reason why I'm looking at my watch right now is because I've been filming for 1 hour and 30 minutes because I'm trying to do part 1 and part 2 all in one go. I am low on energy. So this is the point in the video where I take a small little break and I go and eat a banana. And the funny story is, dude, I've got a toy poodle. Her name is Bonnie. Whenever I grab a banana and open it up, she hears it no matter where she is in the house, and she comes running up to me, and she won't leave me alone until I give her a small piece of that banana. We call it the banana tax. I think it's really funny. But anyways, that's what I'm about to do before we dive into their numbers. And as we take a look at their stock price movement in the past 1 year, negative 32%. Past 5 years, negative 59%. Their forward trading multiple is a 10. So based on that, you would think their financials are absolute trash, right? Well, let's look at it together. So their revenue consistently, reliably growing year after year. Bottom line per share looks phenomenal. They have never been more profitable than they are right now. $8.79. Take a look at their free cash flow. It looks good. It checks out. Balance sheet. I wonder if they have a lot of debt. That's one thing that I want to look at. $86 million of debt on the books. So it looks like they're using their excess cash to pay down the debt on the books. And I wonder if that means they're buying back shares as well, or if they're going to introduce a dividend anytime soon. Yes, they've been buying back the shares. So it looks like the leadership had the insight and the roadmap to understand that their business model is under attack right now because of AI. And when we do the rule of 40 for NICE, the revenue growth year over year is 9.2%. We're going to add that by their free cash flow margin is 26.5%. It's 35.7%. So they missed the mark of that magic number of 40. So I would argue kind of a yellow flag. And that's because their top line's not growing at a double-digit rate. And that's what's holding them back, unfortunately. To be honest with you, I'm kind of taken aback with this one because I think all of the signs point to like, wow, what a great opportunity, and it's a compounder. What I'm trying to say is I don't understand what the alternative would be. If you're going to replace all of your customer service department with agentic AI, robots and everything, who is going to be that company? Wouldn't it be NICE, the one that's doing it already? So I don't understand why they're selling off. Like, is it going to be Salesforce? Is it going to be Microsoft? I don't know. But when we think about the three metrics, I think they're really cheap right now. Now, I don't know if it's cheap because they're screwed, but when your trading multiple is a 10, that's pretty cheap in my opinion. I think their financials look good. In terms of their business model, I think things are good for them because I think more people are going to replace humans with AI in terms of a customer support. So I just don't understand why they're being so harshly punished. Is it because one of the big players, they're barking up their territory, right? So to be honest with you, I almost feel like NICE is over here in the undervalued territory, but NICE is facing fierce competition from other companies that are doing the exact same thing that they are. The only difference is that NICE has first movers advantage and established partnerships with most of the S&P 500, whereas the other ones that we're soon going to talk about, they're startups, and so they have their foot in the door with other startups. And so if that startup eventually becomes the next NVIDIA or the next Tesla, then they'll ultimately benefit from that established relationship. But with NICE, dude, this one's hard. I would argue they have 2.5 out of the 3 because the fact that they're being so harshly punished, something's happening, something's going on. But if I had to ultimately categorize them into this bucket or this bucket, I would have to go with column good. I just feel a little uncertain about the resilience of their business model going forward. Now, moving on to the next one. Who is it going to be? Roper Technologies. Now, I covered this company on this channel a couple times, and they're basically a conglomerate in the software space because they make software for all of the ordinary, not sexy industries, like for the truckers, for the local healthcare systems, construction project managers, and even water meters. The industries and sectors that are often ignored by Google, Microsoft, NVIDIA, and all those other players, okay? So Roper Technologies, as we take a look at their financials, you will quickly see it's a pretty high quality company. Forward trading multiples at 19.7, past 1 year, negative 20% into the red, $400 a share. I think heading into the pandemic, they were on a downward spiral, but they made a huge bounce back. And now they're $7.7 billion of top line gross sales. Their bottom line per share is $14.52. Dude, 2022 was absolutely ridiculous. I'm telling you, that was some accounting manipulation, and that's why their books looked better than they actually were, $42.55. Balance sheet, let's see, downward trend for the cash on the books. That's a yellow flag for me. And I'm guessing they used that money in order to make acquisitions because they don't want to specialize in just one industry. They want to be the provider for all of the weird industries that are often neglected. So their business strategy, it really depends whether or not you like it, but dang, that's a lot of loans on the books, $9.4 billion. I want to see if that's sustainable or not. So we're going to be looking at the debt to EBITDA ratio. It's a 3. The magic ratio is a 3. And it's exactly what it is. So I guess it's not too bad in the grand scheme of things. Free cash flow should be good, right? $2.4 billion. So I think with Roper, this one's interesting. I think their valuation right now is okay. I don't think it's cheap, and I don't think it's fat either. But having said that, if you compare it to their own DNA and timeline, their forward trading multiple is usually above a 20, sometimes above a 30. Right now it's a 19.7. So valuation-wise, I think they slightly moved the needle to the undervalued tier. Not exactly, but they are. Financials checks out. It looks good. Their debt situation could be a little better, but it's not the worst. In terms of their business quality and resilience, I really like that they're targeting the water utility businesses. I really like that they're targeting the construction companies or education systems. They also make software for school districts. But that begs the question, do they pay a dividend? They do pay a dividend. Growth rate is 10%. Payout ratio is 23%. Oh my gosh, the growth in their dividend looks pretty good as well. But that's not a factor that we're considering. I guess it's baked into category number 2 of financials. Guys, I'm about to do something diabolical. I'm thinking about putting them right here, but I think what holds me back is their valuation is still a little fat. I think it could come on down just a little bit more. Because remember, with NICE, their forward trading multiple was a 10. Now, I'm not saying that Roper needs to hit a 10, but when you operate in not so sexy industries, you also have to bake in the fact that the growth prospects are not going to see numbers like NVIDIA, right? So I think if the forward trading multiple was closer to like a 15, I think they would be easily into this column and bucket. But I think all things considered, I think they would be somewhere between the good tier, undervalued tier. At the end of the day, we'll put them right next to NICE. And I think having to pick between the two, because Roper Technologies, I really like their future prospects and I love their dividend profile, I would go with Roper. And some other factors that we need to take into account with Roper Technologies is after they reported their earnings at the end of October, the CEO and a director decided to buy a crap ton of shares. You tell me, if you have line of sight of your business prospects and how things are going, and if you believe that the stock price of your company is inherently undervalued, would you buy $4.5 million? You probably would, right? The average share price, 10,000 shares, $452. The director, Amy Brinkley, she bought 1,200 shares for $450. And when we calculate the Rule of 40 for Roper Technologies, the revenue growth year over year is 13.9%. We add that to their free cash flow margin, 31.86%. It's a 45. So this is undoubtedly a compounder. But anyways, the next company that we're going to be covering is Paychex, ticker symbol Payx. Paychex is in the business of selling payroll and HR software. Take a look at their forward trading multiple is a 19.5. We can round up and just call it a nice 20. Year to date, negative 8.9%. Past 1 year, ooh girl, negative 23%. Past 5 years, 25% into the green, but dang, they're going on a pretty steep sell-off, right? Not too long ago in June, so that's roughly 6 months ago, they were what, $161 a share? gosh, they have fallen quite a lot. Did the numbers check out? At a preliminary inspection, I would say it checks out. I mean, I'm not in love with their earnings per share being stagnant since 2023 at about $4 and some cents, but could be worse. Take a look at their free cash flow situation, $1.9 billion of free cash flow. It's growing up into the right every single year. I like that. But one thing you want to keep in mind, and it bridges the gap as to why their bottom line is not looking so great, is because they recently went through an acquisition and they bought out Paycor, which was one of their biggest competitors doing the exact same thing. So a lot of their growth bakes in inorganic growth. And when you make acquisitions, dude, it messes up the books because you need to think about the fees you need to pay to the investment bankers, the severance payments to the employees you no longer want to keep, the legal fees. And so your numbers get all wonky for a couple or a few years, depending on the severity of the acquisition itself. And when we do the rule of 40 for Paychex, the revenue growth is 12.4% year over year. We're going to add that by their free cash flow margin. That's 33.1%. Dude, a 45.5%. Absolutely juicy. Can't lie. So when it comes to Paychex, I'll be honest with you, I'm not too bullish about their business model because when I think about payroll and software associated with that, they have so much competition. I think about ADP, I think about Workday. They should have been included into this video, I agree. Paylocity. There's also QuickBooks, which is owned by Intuit. I don't think they have an economic moat at all. So when I think about their business resilience going forward, I don't have confidence. Stepping aside from just looking at them as a stock, if I were to buy them and they were a small business and I learned about their business model, I wouldn't feel thrilled. I wouldn't be excited. I'd be kind of scared and hesitate a little bit, right? And that's what I ultimately do when it comes to the stock market. I don't just look at them as a ticker symbol. I look at it as if I'm going to purchase that business and I'm the dude running the show. I'm a share owner. And I just don't feel happy about Paychex. I really don't. Their financials looked good. Their valuation is not bad. So I would argue it's like a 1.7 out of 3. But having said that, I think it's a disservice and a slap to the face for Microsoft and Intuit to place them into the exact same tier. I would feel more comfortable placing them right next to the owl of Duolingo and ServiceNow. I think these three make a lot of sense being in the maybe tier. I think there's something severely wrong with each of these three. Now, I know that's an unpopular opinion, but it's just what I think, okay? The next one, friends and family, is Five9, and they're in the business of selling AI-based customer support. So AI voice, AI chat, email, the entire ecosystem for a company's needs. It's kind of like NICE, except the addressable market and who they partner with a lot smaller. And a huge distinction that I want to make is that with Five9, it supports a real human to do the heavy lifting when de-escalating someone that's all up to here and they're pissed off and they're on the phone with them. The software helps them to do their job rather than the software being AI doing everything. Does that make sense? And what makes Five9 kind of interesting is that their revenue model is based on a pay per conversation or per resolution model. So if they partner with a very high quality business that never has issues with their products or service, they're not going to make that much money, right? Because not many people are going to call in and be like, hey, I have a problem, right? They're not going to do that. But on the other hand, if they partner with Jeep, lousy cars, or HP laptops, Five9 is going to make absolute bank. So taking a look at their numbers, their forward trading multiple is a 5.8. Wall Street's already priced them for death. They're not even expecting anything from them. At that rate, they hate them. One day, oh my gosh, negative 7.5%. Year to date, negative 12% past 1 year. Dude, this is looking really rough for them. And it's because they raised their fiscal year 2026 guidance, but their longtime CEO, he's stepping down. And the markets, whenever there's a leadership transition with like Target, Duolingo, or even Mercado Libre, they punish you very harshly because of the uncertainty and the transition of like, is this leader going to be a good leader? And remember that conversation with NICE where I was like, I don't understand why they're being smacked in the left nipple. Well, during my break, I did some research and it's because it's been leaked that Google and Amazon right now with the developers that are working for them, they're trying to roll out their own AI customer service platforms. And that's pretty terrifying for Five9, to be honest, because the best and the brightest minds, especially if you want to make a lot of money, you do want to go work for Amazon or Meta or Apple. And to know that the Mag 7 is making a product that's going to make your business obsolete going forward, that's absolutely an existential threat, okay? But having said that, for the time being, I mean, their numbers look phenomenal. And the fact that they're trading multiple as a freaking 5, I almost feel like that's ridiculous. But nonetheless, I think they're getting the exact same treatment as the Trade Desk because Amazon is encroaching upon their territory. The market is saying, oh, Trade Desk, you're screwed, you're dead. So for Five9, I think their valuation, I would argue they're very, very cheap, okay? Financials looked great, but now that we understand the sell-off for NICE and Five9, I think that changes a lot. Even though right now they trade for $17.59, who is to say that Five9 won't be $11 by the end of the month or $5 by the end of the year, right? So, gosh, this is going to be very controversial. I know it's going to give me a thumbs down. I'm so sorry. But I think Five9, I'm going to have to put them into this bucket right here. I think there's a lot of uncertainty with this company because the big money and the hedge funds, they feel so bearish about them that even if they do keep executing and posting phenomenal numbers, when you have a PE ratio of a 5, I think that says volumes that they just lost all confidence in you. So I think I'm also going to update NICE and put them into this tier right here. Even though right now their forward trading multiple is a 10, who is to say that NICE won't be $80 or $75 a share going forward? Because if in fact Google and Amazon, they do roll out their customer service platforms, yeah, I feel like they're screwed. And when we do the rule of 40 for Five9, the revenue growth is 12.5% year over year. The free cash flow margin is 14.6%. Guys, it's 27.1%. Dude, there's no other way to spin it or manipulate it. That's a red flag. That's just not good enough for a software company. Dare I even say with a rule of 40 percentage of a 27, that's in the realm of a value trap. I mean, obviously, if it was like 23 or 21%, I could say that with confidence. 27%, still, it's unattractive. And the next one, friends and family, is Freshworks, another AI-based customer support software, but their portfolio is a little more diverse than Five9. So their software manages the customer ticket system, it manages the IT help desk, and the sales department. And instead of focusing on external customers reaching out for support, they're doubling down and pivoting to becoming more of an internal employee management platform, kind of like ServiceNow. And one might argue that's a stupid business move, but I also think it's them understanding that Google and Amazon's about to come and eat their lunch. And that's why when we think about the Mag 7, as scary as they are, putting your money into them, it kind of diversifies you across the board, right? Robo-taxis, the cloud space, AI, the streaming entertainment platforms, digital advertising, kind of covers all your bases. But anyways, with Freshworks, $11 a share, forward trading multiple is an 18. I think that's why they're trading for a premium in comparison to NICE and Five9. It's because they're making that pivot instead of just AI customer support. Now it's managing the people that's already inside of an organization. Past 1 year, yeah, it doesn't shelter them from the fact that they're negative 33% into the red. Financially, though, I think they're crushing it. In their free cash flow situation, it's growing 80% year over year, 46% year over year. Again, that's really good. What about the bucks? $800 million. And then total debt, $39 million, so $773 million left over. In other words, they're cash heavy. So when it comes to Freshworks, their valuation, it's hard to say whether or not they're cheap. I mean, $11, I want to take a look at the entirety of their history. The IPO during the pandemic, when the SPAC frenzy was happening, and they were roughly $46 a share. Dude, if you bought into them at 46, you're probably super pissed off about their performance. The rule of 40 for Freshworks, we're going to be doing 18.2% for the revenue growth year over year, 26.3% for the free cash flow margin, 44.5%. So I guess one could argue out of the 3 AI-oriented customer support software businesses, Freshworks, I think they're the most efficient. But at $11 a share, one might argue this might be it. This might be the bottom. But I don't know, right? When it comes to Five9, Nice, and Freshworks, who is to say they're not going to go lower? So for Freshworks, that would be what, $8, $7 a share? If I had to make an educated guess, I would go ahead and assume that Salesforce or Oracle or SAP, they're going to go ahead and just buy this business outright, or even Five9. But as it stands, I think all 3 of these AI customer support software enterprise systems, I'm not feeling too confident in their future. If you are, you gotta let me know why, because I'm not seeing it. And the next one, friends and family, is gonna be Autodesk, ticker symbol ADSK, and they make software for engineers, architects, and construction project managers. So in college, a fun fact about me is that 3 of my roommates were engineers. So I actually got to see one of their software, which is called AutoCAD, every single night as they worked on their homework. And so based on my understanding, if anything, just like Adobe, I think AI is gonna make Autodesk's software across the board better for the end users in order to do more while saving time. That's just my opinion. If I pull up Autodesk on stockanalysis.com. By the way, the website that I'm using, Stock Analysis, if you like what you see, you can use my referral link down below to sign up, and it'll give you a discount on top of whatever promo they've got going on. But anyways, past 1 year, negative 8% into the red. Past 5 years, negative 13.8% into the red. If we maximize the timeline, 30,500% into the green since, like 1986. So a compounder by design and nature. It's just in the past 5 years. Some rough waters, okay? Current trading multiple is 51, but I don't care. I'm looking at this one right here. Forward trading multiple is a 24. Revenue situation looks phenomenal. The free cash flow per share is $9.81. If I just do this real quick, are you going to be mad at me if I do this? Divided by $9.81. The price to free cash flow ratio is a 27. That's more digestible than a 51.5. Forward trading multiple is a 24. Gosh, I really like this one, but why don't they pay a dividend? Especially if you've been publicly traded for decades and you're profitable. Dude, you got to pay a freaking dividend, Autodesk. And when we take into account the Rule of 40 for Autodesk, the revenue growth is 15.6% year over year. Free cash flow margin is 30.7%. My goodness gracious, 46.3%. Absolutely juicy. I told you, right? Their software prints cash. But anyways, evaluating them based on the 3 criteria metrics, financials look good. Business quality, I believe in them. I think their future is bulletproof. I think they're going to be okay in light of AI. But their valuation could be better. I think 265, 200 a share, we're talking, right? So when it comes to Autodesk, I would put them right here, right next to Roper. So that just about wraps up all of the software companies that I wanted to talk about today. I'm trying to see if I need to make any last minute adjustments. This is how I would categorize them in the undervalued tier, and I'm not trying to be that guy, but if I had to and I had to move one into the no way Jose no matter what category, it's got to be one of the customer service AI software or Paychex, the accounting, payroll software. I don't know, I feel like it's going to be one of these 3. I think I could just close my eyes and pick one of these 3, put them right here. And I don't think that would be too harsh. As a matter of fact, let's just go ahead and do that right now. So, what do you think? And I ask you that question because I know at least one of these placements annoyed you. So now is the time to speak up. Let me know in the comments section. And I'll tell you what, if you're saying, actually, it doesn't look too bad, and we see eye to eye, I ought to kiss you right now, right on the cheek. And before I sign out of here, I wanted to give a dedicated shout out to Ray. I appreciate you for contributing to the Amazon baby stuff because yesterday I broke the monitor. Dude, I was so upset. I was like, how could I be so careless, right? And your contribution to the diaper fund it's going to be used to replace it. So I'm so grateful, man. Thank you so much. Seriously, huge shout out to you, Ray. Having said that, to the rest of you guys, I love you. Stay safe. Good luck in the stock market, and I will talk to you next time.